Hey everyone, welcome back to Yuri's Box. In this video I'm going to talk about the yield curve. If you like this kind of content, consider leaving a like and subscribing to the channel. And as usual, nothing in this video is financial advice. I've waited a bit before making a video on the yield curve because I wanted to see how things evolved. And granted, the fact that I'm making this kind of video now means that we'll just plunge right back, straight back to inversion. But as far as things seem to be moving for the time being, we are above the yellow line, which is the 50 basis point spread between the 10-year and the 2-year yield. And why is that significant? Well, in my previous videos, I spoke about the yield curve as potentially the last recession indicator standing, because a lot of recessionary indicators that usually work really kind of failed. And my speculation was that potentially the yield curve would be the last one standing and potentially eventually being correct and predicting a recession. Now, how does the 10-2 spread predict a recession? Well, if you were to look at it from a time-based perspective, it's hard to find any correlation, okay? Because from inversion, meaning the 2-year yield is yielding as a higher yield than the 10-year. So whenever it's below the 0% mark, which is the white line, whenever it goes to inversion to uninversion, that typically means that something's up, all right? But again, if you take the perspective of looking how long it takes to go from uninversion to inversion, it's quite noisy. You can't really find any significant correlation across time. That is why I think the best way to go about the yield curve is to think about the 50 basis point spread as your first yellow card, all right? When you cross the 50 basis point spread, that is the market's way of telling you something might be up, all right? Is everything gone to hell in a handbasket? Probably not yet at least. But definitely something's up, and you need to be paying attention. And that is consistent because, for example, if you see prior recessions, starting from 2020 in the COVID recession, I mean, you can debate whether you can call that a recession or not. You see the yield curve pop up 50 basis points, over 50 basis points, just as things started to turn sour. If you go back to 2008, switch to the weekly here. Again, excuse me for my voice, but I'm still I'm working on it. That's all I can say. In 2008, in the 2008 cycle, we went above the 50 basis point spread around October to November. And actually, when you look at when the NBER dated the recession of 2008, it actually started at the end of 2007, meaning between November or December. I think December. So again, when you get over the 50 basis point spread, that's kind of the market's way of telling you need to be paying attention because something is going on, right? I don't know what, but something might be going on. Looking again back at 2001, you had an inverted yield curve, meaning the 2-year yield is higher than the 10-year yield. And it basically went over 50 basis point spread in March of 2001. You can go back to 1990, the same thing. As we approached the 1990 recession, we just blasted through the 50 basis point spread. And again, as I said, the yellow line is kind of the first line in the sand. Again, I make the analogy if you watch football or soccer, if if you're American. First yellow card, second yellow card, you get a red card and you're out. Meaning the 100 basis point spread is the red card. if you go over the 50 basis point spread line and you go further and reach the 100 basis point spread line, something happened, all right? Something's wrong with the economy. And again, you can see that in 2008. We went over 2001, right here in 2008. And again, this is when the NBR actually backdated the recession, right? They say it started right here in December of 2007. All right. So where do we stand today? Today we stand just above the 50 basis point spread. And there are a few things happening. The first thing I would look at is what has been happening in bonds, all right? I wouldn't get too excited about today's move. It is a step in the right direction. And it is potentially a step in the direction of hinting at the fact that potentially, I mean, this is still just one day, right? 2 if you count Friday, of declining yields. But if this were to continue, as I hinted in my previous videos, you could actually make a stronger case for what this move right here being, this one right here, being liquidations. As you know, my instinct really just told me. I thought back to my crypto days when I used to see these huge candles and indicating liquidations. I know that's the kind of analogy I made on Wednesday morning when I woke up and actually saw this this incredible candle on bonds. It was a sight to behold. So we had general unwinding, and the problem with this unwind is that it was the wrong kind of correlation with the dollar, because this kind of price action where you see the dollar decline and yields go up isn't something that you usually see in normal times. You don't usually see it outside of stressful times for financial markets. And I pointed this out in my previous video. What am I talking about? If you go and look at, for example, what happened between, let's go to the GFC, the 06-08 cycle. Okay. And you look at December of 06, which would be right here. There we go. Right here till June of 07, which would put us right here. And you go and look what bonds were doing, like the really long yield. All right, so the 30-year yield from December 06, meaning right here to here, we had yields go up. All right, about 85 basis points. At the same time, when the dollar was really declining. Another good example is January of 08, right here, and really you can consider Bear Stearns as a catalyst from March of 08 until June of 08. You saw the 30-year bond go up 63, you can say 64 basis points. At the same time, when the dollar, where are you? Right here, January of 08 till really March, went down 9%. And again, this is something that we've actually just seen now, as I was just talking about right now. The problem with the yield curve where it is, the problem with the yield curve where it is, in my opinion, problematic for two things. One is exactly this. We've seen the same kind of bad correlation where you see bonds sell off and the dollar sell off. And the second, in my opinion, would be credit spreads. I think that as the last data point we have is I think Fridays, and actually credit spreads have just pulled back a tiny bit, if I'm not mistaken, about 4.26. This hasn't updated yet, but the story here is that we have broken out of the declining channel on credit spreads. And again, for people that are new, what are credit spreads? Well, the way you have to think about credit spreads, and the most simple explanation I can give you, is that you are comparing what spread? What is this spread? You're basically comparing think of a triple B rated corporation, right? A triple B rated bond issued by a private company, and you're comparing that yield to the yield of its equivalent on the treasury yield curve, meaning with the same maturity. All right. So say you have a 10-year triple B rated bond, and you're measuring it against the 10-year treasury. Okay. 10-year triple rated bond against the 10-year treasury. And what you're measuring again is how much premium are investors asking in the marketplace in order to give that money to these corporations that are issuing this low-rated debt. And whenever you see credit spreads go up, that is an indication that there is high bankruptcy risk, perceived bankruptcy risk, all right? And why would that be? Because again, if the investors are demanding extra yield, the way you have to think about it is that investors are demanding more yield because they're seeing the possibility of bankruptcy, right? So they're going to give you the money, but they want a little extra, just because they're taking on more risk compared to the treasury, which is risk-free, or at least so far. Right? You never know what the future holds. So, excuse me. And again, when you see credit spreads up, that is an indication that bankruptcy risk is perceived to be high, or at least higher. Whenever you see credit spreads at cycle lows, the opposite is true. Bankruptcy risk is perceived to be low. So investors are demanding less premium, or let's call it like that. And I think that this is the second part of the story that you need to be paying attention at, because we have broken out, and we haven't just broken out, say, by, a couple of, say 50 basis points or something ridiculous like that. We're up, right? We're up. And we're still in the midst of, Mr. Trump's wild ride. That's the only way I could settle it, I could say, because even today we had, I didn't follow everything as much as I usually do. I was, busy, but overall, we're still dealing with a lot, okay? So it is unlikely, as things stand, things could change very quickly, all right? But as things stand, it is unlikely to see, the conditions that we saw back here from basically after September till February, where, we were still in the status quo, strong and resilient, we're going to have tax cuts, and then the tariffs, everything got upended. And so we're still dealing with it. So again, I think that what the yield curve is telling us, in my opinion, and again, it could be something completely different, but what I would look at is credit spreads, and what usually happens after you see this bad kind of correlation between the dollar selling off and yields going higher. Because again, if you look at what happened from January of 2008, and really the lead up to Bear Stearns and after the collapse of Bear Stearns to June of 2008, you saw yields decline after that quite significantly. All right, we went back, we actually swept the lows right here. We went from 4.8 to 80 basis points. And actually, I forgot to mention the best example, which is right here. This right here marks the collapse of Lehman Brothers. This candle right here. And actually, during this time, we saw yields pop up higher, meaning we went from 4 till 443, meaning that a basis, 40 basis point increase at a time where, lo and behold, if I can find 2008 again, where are we? Right here. This is the collapse of Bear Stearns. So when yields went up, the dollar went down. And again, I use all of these examples to potentially hint at the fact that what we saw this week was potentially just liquidation, forced liquidation. That's how I spoke about it on Wednesday morning. That's what I've been hinting at, or really, that's where my mind has been for the last few days. But again, what is the yield curve telling us? Potentially, watch out for credit spreads, and watch out what happens after we see this bad correlation between the lower dollar, higher bond yields. Because again, if you look at what happens after, you have Lehman Brothers collapse right here, up 40 basis points, going up. Sure enough, the direction for bonds is down. And I'll finish off with saying something that I actually said in yesterday's video. Bonds have the bad habit of looking like they don't do anything for a long time. Bonds are one of the most boring investment you can make, right? However, when you really need them, eventually bonds do what they're supposed to do, right? It might take them a while, like in 2008, all right? We were still at, the starting point, still in October of 08, well after Lehman Brothers. But again, eventually, this is the kind of move that, you're looking for when you're buying the long end of the yield curve. So to summarize, the fact that we have a yield curve potentially just starting to get above 50 basis points is kind of the first, yellow card, or the first red flag, if you want to wave. In my opinion, it doesn't mean that we're, just went off a cliff, but we're getting close to a cliff potentially. And I think the two culprits, you're welcome to point anything else out. In my opinion, are credit spreads, the move that we've been seeing in credit spreads, excuse me again, and the the bad correlation with the dollar and bonds, and because and what that entails, meaning what happens after we see the negative correlation between the bad correlation between lower dollar, higher bond yields. That tends to reverse. You start to see the dollar surge, and you start to see lower yields. Will that occur? I have absolutely no idea. Again, I just, give you my opinion. I think that I wouldn't be surprised if we actually see bonds retrace just a little bit. Again, that will also bank on, the liquidation thesis being correct, and potentially us shifting, as I've been saying in my previous videos, to more of the fundamentals. As time goes on, we just tend to leave the tariff drama behind us and shift back to thinking about what does the economy look like. All right, I'll leave it at that. If you like this kind of content, consider leaving a like and subscribing to the channel, and I'll see you next time. Hopefully I'll be feeling better. Bye.